I'm speaking with Geoff Di Felice, Portfolio Manager at Cooper Investors. Geoff, thank you very much for participating in the Inside Networks Equities and Growth Symposium.
Pleasure to be here, James.
Geoff, could you tell us a little bit more about the fund of which you are co-portfolio manager?
Sure. So the Endeavour Fund was started in September 2021. And what we noticed is that the listed equity markets have got a few trends going on, things like passive investing, that are making it more short-term, less value-focused, less focused on governance and things around management. And what we saw was there's a real opportunity for somebody to take a longer-term private market approach to listed markets. And so what that means is we're long-term, we specialise in a few industry verticals, and we build very concentrated portfolios. And so we look ultimately for businesses with operating and strategic levers to drive value, so how they can improve their proposition to their customers, make more money, and we like to back people with the will and talent to win. And when needed, we get engaged and help support companies to realise their value as well.
Obviously, at time of speaking, Geoff, we're seeing very large gyrations in the drawdown direction on global markets. Is that a time where an active manager wants to see, or as you say, taking a long-term approach? Is it something that is not really changing the approach all that much?
Yeah, I mean, it's both of those things, and I think that you have to take a long-term approach that's based on the things that are going to work over the long term. And so for us, I mentioned we specialise. We specialise in four verticals, which are content, rollouts like restaurants, niches, and then royalties as well. And for us, why do we love these businesses? We love these businesses because they're simple, they're resilient, irrespective of what's going on in the world. If someone can provide you a cheap meal that's fast and tasty, you're going to buy it. If you're going home tonight, you're going to turn on your TV and consume some content. And so these businesses are resilient to those factors. And then we look for management teams that can grow value. At different times, those things might price differently, and so definitely it does give us the opportunity with sufficient volatility to make other investments. But I think stepping back, some of these trends are about governments solving their debt. Tariffs are ultimately a tax on consumers. This is a long-term trend that won't be solved in this one foul swoop. This will be an ongoing issue for the world to deal with over the next 10 years. We are transitioning from one global leader to another. That will continue to take place. And so, and equity markets, by and large, were pretty expensive. And so I would probably not think that this is a particularly volatile period relative to what's going on in the world. I think maybe it's a bit of an awakening about what some of those risks have been.
You've got a very large opportunity set in global small caps. How do you physically narrow that down and manage the size of it to a universe that you can actually work with of high quality ideas?
It's true, James. It's a huge universe and huge opportunities set out there. And really we've just spent the last decade plus trying to understand the types of cultures we want to invest behind, the regions of the world that we have an energy and electricity or an alignment with, and what are the business models that we understand, can value, and want to be invested in. And so the way we've shrunk that down is firstly the types of people. We invest in what we call proprietorial management teams. So these are founder or founder-like businesses. And then, as I said, we specialise in four verticals. So content, rollouts like restaurants, niches, and royalties. And so that shrinks the world down for us materially. And then within that, we look for trends that are going on that give these companies the opportunity to create value. And so that could be a content business that the management team are able to grow by internationalising it, striking better deal with media rights people. They're the types of opportunities we look like. So whilst the broad opportunity set is very large, where we focus on is a very specialised, narrow piece, and that allows us to know these businesses as well as anyone. And again, we sort of have the posture of sitting back like we're a long-term private owner. And so that's got to be a very focused, specialised niche that we sit in.
It's funny, we were looking not that long ago at a relatively overvalued situation in markets, and I would have asked you, what kind of opportunities are you seeing that are resilient and still, in your view, mispriced? But has the last week or so thrown up more of those kinds of opportunities?
It's definitely, any time that prices go down 5, 10, 15, 20%, the opportunity set changes depending on what things get priced at different levels. But your point, the very high quality growth companies were sitting on high valuations, and so for them to come off 10 or 20% is not material relative to where they are. So I don't think there's, bargains on those types of businesses, but there's certainly way more opportunities than they are. And I guess for us, we're a well-capitalised fund, meaning we're sitting on substantial cash to deploy. So we would be very happy for another week or so of this sort of volatility.
You mentioned the 4 verticals that you focus on. Are those the ones where the structural or cyclical tailwinds you've identified to build the portfolio around are still going to be the ones you lean into in corrections like this, that you would still, all your activity would still be within those verticals you've identified?
Exactly. So nothing changes for us. It's business as usual in terms of where we focus. It depends on what the actual volatility is driven by, but in this situation we have more conviction than ever that these are the verticals we want to be in. Then those things get repriced, but the trends we look for are we'll call them inexorable or inevitable trends. And so content, the area we really like is we think sports content is going to become more and more valuable because of streamers. There's nothing that's changed that given what's taken place, and we don't see that. We think that there's a big movement away from fast food to fast casual. The things driving that haven't changed in the last week. And so those tailwinds are decade-long tailwinds that the reason we like them and we call them inevitable is because the force that's changing them won't be put off by short-term turbulence.
How do you see this fund sitting in a broader client portfolio, whether the client is more focused on diversification or more focused on alpha generation?
Yeah, so I mean the focus of this fund has been providing high absolute returns but are uncorrelated. And so whilst we sit in small listed markets, our returns have not looked like that. They've been much higher and significantly lower correlation to both large cap and smaller listed equities. So we'd say someone who's looking for the returns of listed equities in a private markets-like approach without the volatility or correlation of listed markets.
Geoff Di Felice, thank you very much for your time.
My pleasure. Thank you, James.